Episode 3, and this one is different. Ras Al Khaimah. Most investors who look at UAE property start with Dubai, consider Abu Dhabi, and stop there. RAC doesn't usually make the shortlist, and for a long time that was fair. But something structural has changed here, and when you see numbers like these on the market this small, that's usually a signal worth paying attention to. Look at the two price numbers side by side. There is a 1,100 dirham gap between average and prime location. That's not normal for a market this size. It tells you exactly where capital is concentrating and where it isn't. Then look at the transaction count. Just over 6,500 deals in a full year. Dubai does that in under 2 weeks. The gap between the return story and the liquidity reality, that is the entire RAC investment questions. Everything else follows from it. Here's the thing about RAC that most people miss. It is not the yield that's interesting. You can find yield in plenty of markets. What's different here is that one project is about to fundamentally change what it is Emirates is. The Wynn Resort isn't just a hotel opening, it's a category shift. It moves RAC from a quiet coastal market into an international leisure destination, and the return numbers you're seeing now, they're pre-category shift pricing. Whether you believe that shift fully materializes, that's the whole bet. Now the other side, and I want to be direct about this. When 80% of your transactions are off plan, the secondary market is largely theoretical. You are not buying into a tested resale market, you are buying a price expectation and hoping the delivery matches it. And the infrastructure gap is real. Outside the waterfront communities, holding a tenant in RAC over the long term is harder than the headline yield suggests. That is not a set and forget investment. It requires conviction, patience, and the financial position to hold if the market takes longer to develop than projected. Two opportunities I flag specifically. Short-term rental near Al Marjan, post-Wynn is the most direct way to capture the tourism uplift without betting on capital appreciation. If the resort performs, the short-term rental economics around it becomes structurally different. You are operating in the hospitality demand of an international destination, not a local residential market. And RAC Centrals is worth watching for anyone with a longer horizon. Infrastructure precedes value. The pattern of positioning ahead of delivery rather than after is where the compounding happens. The risk I focus on is the one that's already in the price. The Wynn Resort is expected in 2027. The timeline is priced into Al Marjan exits right now. If it opens on schedule and performs to expectation, the thesis works. If it is delayed by 18 months or the gaming environment gets complicated, there's no secondary narrative holding the price up. I've seen markets built around single catalysts. When the catalyst delivers, the returns are multiplying. When it doesn't, or is lower than expected, the unwinding is uncomfortable for anyone who needs to exit. Know what you're holding and make sure you can afford to hold it. So, where does that leave us? RAC is the highest yield market in the UAE, that's real. It is also the market with the thinnest exits, and its entire investment story, right now, runs through one resort opening in 2027. If you are a patient investor, you believe the win thesis, and you don't need to sell within 5 years, the return profile here is genuinely one of the most compelling in the region. If any of those conditions doesn't apply, Dubai gives you the same tax environment, similar golden visa access, and you can exit with when you need to. Know which investor you are, then the answer becomes clear. Next episode, the four remaining emirates, Sharjah, Ajman, Fujairah, Al Quwain. Smaller market, but the data there is more interesting than most people expect.